The amateur trader watches the minute chart, chasing every tick and swing, wondering why he's always on the wrong side. Meanwhile, the composite operator, the smart money, has already marked his campaign on the weekly chart. He knows that the dominant trend, visible only to those who step back, carries more force than 1,000 intraday fluctuations. Position yourself with the tide, not against it. For example, imagine a stock consolidating for 3 months on the weekly chart, building a subtle accumulation pattern. The daily chart shows chaotic noise, false breakouts, whipsaws, panic selling. Retail traders, fixated on the hourly movements, get shaken out repeatedly. But the operator, studying the higher time frame, recognizes the methodical absorption of supply. When the markup phase begins, he's already positioned, while the crowd is still recovering from their stop losses. Gentlemen, let me explain to you one of the most fundamental principles of market behavior, a principle that, once grasped, will transform your entire approach to speculation. I call it the law of cause and effect, and it is as immutable in the stock market as the law of gravity is in the physical world. Consider this carefully. Every significant move in the market, whether up or down, must have a cause that precedes it. You cannot have effect without cause. When you see a stock advance 50, 70, or 100 points, I can assure you that somewhere in the preceding weeks or months, a cause was built that made such a move inevitable. That cause is accumulation, the quiet, methodical absorption of all available supply by interests far more powerful and informed than the general public. Now, where does one observe this cause being built? Not on your minute charts, my friends. Not on your hourly fluctuations. The composite operator, the smart money, the informed interests who move markets, requires time to execute his campaign. He cannot purchase 500,000 shares in an afternoon without driving the price against himself. No, he must work patiently, buying on weakness, supporting on declines, absorbing the supply that fearful holders throw at the market during periods of discouragement. This accumulation process unfolds over weeks, sometimes months. It appears on your weekly and monthly charts as a trading range, what I call a horizontal channel. To the untrained eye, it appears as merely dull, sideways action. But to the student of market behavior, it represents the cause being methodically constructed. Each week of accumulation adds to the potential energy, like compressing a spring that will eventually be released. The beauty of this law is its proportional nature. The longer the period of accumulation, the greater the subsequent advance must be. A 3-month accumulation pattern on the weekly chart creates sufficient cause for perhaps a 30 to 40% advance. But a 9-month accumulation, that is building cause for something far more substantial, perhaps a doubling or tripling of price. This is why I insist that serious students of the market maintain their charts on the weekly and monthly basis. The daily chart shows you the tactics. The weekly chart reveals the strategy. And it is strategy, the grand campaign of the composite operator, that determines your success or failure in speculation. When you position yourself in alignment with a cause that has been properly built on the higher time frame, you are placing yourself on the same side as the most powerful interests in the market. You become a fellow traveler with the smart money, rather than the victim they profit from. The effect, the substantial move in your favor, becomes not a matter of hope, but of mathematical inevitability. Remember, there's always cause must precede effect. Find the cause on the higher time frames, and the effect will take care of itself. Let me share with you a critical distinction that separates the professional operator from the perpetual loser in this game of speculation. It is the ability to distinguish between noise and signal, between the meaningless chatter of intraday price action and the genuine voice of the market, telling you where it intends to go. Picture, if you will, a crowded trading room. Dozens of voices shouting simultaneously, some in panic, some in greed, some simply reacting to rumors or tips. In such an environment, could you possibly hear a single person attempting to convey important information to you? Of course not. The noise drowns out the signal, yet this is precisely what the amateur trader does when he fixes his attention on the minute-by-minute fluctuations of price. Every tick, every momentary dip or rally on the intraday chart represents an emotional reaction. Perhaps a nervous holder decides to sell. Perhaps an algorithm executes a programmed trade. Perhaps a floor trader pushes the price down to trigger stop-loss orders so he can accumulate at better levels. These are not signals about the market's true direction. They are noise, static, interference that obscures the real message. Now I want you to understand something fundamental about time itself as it relates to price movement. Time acts as a filter. The longer the time frame you observe, the more effectively it filters out these random emotional reactions and reveals the true underlying force moving the market. A 15-minute chart is nothing but a recording of moment-to-moment panic and greed. A daily chart begins to smooth out some of this emotional interference. But a weekly chart shows you only what matters: the sustained directional pressure applied by large, informed interests. Consider this practical example from my own observations. I have watched stocks decline sharply at the hourly chart, drops of 3, 4, even 5% in a single session that appeared catastrophic to those watching every tick. Yet when I examined the weekly chart, this same decline registered as nothing more than a minor reaction within a clearly defined uptrend. The weekly support level held perfectly. The larger accumulation pattern remained intact. The composite operator was unmoved by this temporary commotion. The inexperienced trader watching his screen all day saw disaster and sold in panic. The informed operator checking his weekly chart in the evening recognized an opportunity to add to his position at favorable prices. Who do you suppose profited from that transaction? This is why I cannot emphasize strongly enough the importance of maintaining your primary analysis on the weekly time frame. Use the daily chart to refine your entry points, certainly. But let the weekly chart tell you the truth about market direction. It has filtered out the lies, the manipulations, the emotional outbursts that plague shorter time frames. The signal you seek, the true intention of smart money, can only be heard clearly when you step back far enough to let time filter the noise. Position yourself according to what the weekly chart reveals, and you will find yourself consistently aligned with the dominant force in the market. Time is your filter. Use it wisely. Now let me address a matter of simple arithmetic and logistics that every serious student must grasp if they wish to understand how markets truly operate. The composite operator, the big banking interests, the powerful syndicates, the informed pools cannot move in and out of positions the way you and I might trade 100 shares. Their very size creates constraints that become visible to those who know where to look. Imagine you are a banking house seeking to accumulate 2 million shares of a particular stock for a major campaign. The current daily volume is perhaps 300,000 shares. Can you simply step into the market and purchase your full position in a week? Absolutely not. Such aggressive buying would immediately drive prices against you, alerting every other operator on the street that something significant is afoot. You would end up paying far more than necessary and would likely attract competition for the very shares you seek to control. No, gentleman, the intelligent operator must work patiently and methodically. He buys on weakness when discouraged holders are willing to sell. He supports the stock on declines, preventing it from falling so far that it attracts bottom fishers who would interfere with his accumulation. He may even orchestrate minor sell-offs to shake out weak holders and create additional supply. This entire process, this campaign of accumulation, requires weeks, often months, to execute properly. And here is the crucial point. This activity leaves footprints. These footprints do not appear on your hourly charts, where they would be indistinguishable from normal trading noise. They appear on the weekly and monthly charts as distinct, readable patterns. You will observe a trading range that persists far longer than random consolidation would suggest. You will notice volume characteristics that reveal absorption days of heavy volume with minimal price decline, indicating that strong hands are buying everything weak hands are selling. I have studied countless examples where stocks traded in narrow ranges for 3, 6, even 9 months periods that seemed interminably dull to the general public. The newspapers declared these stocks dead money. Impatient traders abandoned them in search of more exciting opportunities, yet all the while someone was quietly, systematically absorbing every share available. The weekly chart told this story clearly to anyone disciplined enough to read it. When the accumulation was finally complete, when the last weak holder had been shaken out and the operator controlled a sufficient position, the markup phase began. And it was always those who had recognized the accumulation on the higher time frame who positioned themselves correctly and profitably. The opposite holds true at tops. Distribution takes time. The operator cannot dump 2 million shares into the market carelessly. He must distribute during strength, feeding shares to an eager public convinced that prices will go higher still. Again, this process leaves unmistakable evidence on the weekly chart: heavy volume on rallies that make little upward progress, a persistent trading range at elevated levels. Learn to read these institutional footprints on the higher time frames, and you will know what the smart money is doing while the crowd remains oblivious. I want you to grasp a principle that will fundamentally alter how you evaluate trading opportunities. Not all breakouts are created equal. A breakout from a 6-hour consolidation on your intraday chart and a breakout from a 6-month consolidation on the weekly chart are as different as a firecracker and a cannon. Yet I observe traders daily who treat them with equal significance and who wonder why their results are so disappointing. Let me explain the mechanics of why this is so. When a stock breaks out from a prolonged consolidation on the weekly time frame, what has actually occurred? Remember our discussion of cause and effect. That 6-month trading range represents cause substantial, cause built through systematic accumulation by powerful interests. Every share absorbed, every weak holder shaken out, every moment of patience exercised by the operator adds to the compressed energy ready to be released. Think of it as a dam holding back water. A small dam built in an afternoon might hold back a creek. A massive dam, constructed over months, holds back an entire reservoir. When each breaks, which release carries more force? The answer is self-evident, yet traders ignore this principle when they chase breakouts on lower time frames. Now consider the capital commitment involved. When the composite operator completes a 6-month accumulation campaign and finally initiates the markup phase, he has committed enormous resources, both financial and temporal. He has planned this campaign meticulously. He has absorbed millions of dollars worth of stock. Do you honestly believe he intends to profit from a mere 5 or 10% advance? Of course not. His cause demands a proportional effect, a move substantial enough to justify the time, capital, and effort invested. Contrast this with the typical intraday breakout. What cause has been built in 6 hours? Perhaps a few large orders created temporary support and resistance. Perhaps some algorithmic pattern triggered technical buying. But there is no substantial accumulation, no committed operator with deep pockets and firm intention. The breakout may succeed for a brief period, but lacking the foundation of genuine cause, it collapses at the first sign of resistance. I've witnessed this pattern countless times in my years studying the market. A stock consolidates for 4 months on the weekly chart, building a clear base. When it finally breaks out, it advances 40, 60, sometimes 80% over the following months. The move has power, conviction, follow-through. Meanwhile, that same stock produces dozens of small breakouts on the hourly chart during those 4 months breakouts that fail within days, trapping the impulsive trader who cannot distinguish between genuine power and temporary noise. The professional operator knows this distinction intimately. He waits for breakouts born from substantial cause on the higher time frames. He ignores the siren song of intraday opportunities that promise quick profits, but deliver only frustration and losses. Which type of trader will you be? The one chasing firecrackers, or the one positioning himself before the cannon fires? The choice and the consequences are yours. Gentlemen, let us now discuss a matter of cold, hard mathematics, for ultimately, success in speculation reduces to arithmetic. You must risk less than you stand to gain, and you must be right more often than you are wrong. These are not matters of opinion or sentiment. They are mathematical necessities, and I can demonstrate to you conclusively that the higher time frame provides a decisive mathematical advantage. Consider the trader who operates from the hourly chart. Where does he place his protective stop-loss? He must place it relatively close to his entry, perhaps 1 or 2% away, because the patterns on his time frame are small and the trading range is narrow. This seems prudent, does it not? He is controlling his risk tightly. But here is the fatal flaw in this approach the market breathes. Prices oscillate naturally, even within the strongest trends. The stock that is destined to advance 50% will nonetheless experience normal reactions of 3, 4, or 5% along the way. These reactions are not failures of the trend, they are the natural rhythm of market movement, as inevitable as the tide going in and out, even as the ocean level rises. What happens to our hourly chart trader? His tight stop, placed according to his small time frame pattern, gets triggered by normal market action that has nothing whatsoever to do with the validity of his analysis. He is stopped out, takes his loss, and watches in frustration as the stock resumes its advance without him. This occurs not once, but repeatedly, death by 1,000 small cuts. His account bleeds slowly but inexorably, even though his directional assessment may have been entirely correct. Now observe the trader who positions himself according to the weekly chart. He identifies a support level that has been tested and held over months, a genuine structural support representing the composite operator's line in the sand. He places his stop below this level, perhaps 8 or 10% from his entry. Yes, this appears to be a larger risk in dollar terms, but consider what he has gained. That weekly support level will not be violated by mere noise or normal market oscillation. When he is stopped out, it is because something genuinely significant has occurred. The entire market structure has failed, and he should indeed exit the position. His stop is not being triggered by random fluctuations. It is positioned at a point of true structural significance. The mathematics become compelling. The hourly trader risks 1% to potentially gain 3%, but he is stopped out 7 times out of 10 by normal volatility. The weekly trader risks 8% to potentially gain 40%, and he is stopped out perhaps 2 times out of 10 because his stop is positioned beyond the range of normal market action. Which trader accumulates capital over time? The arithmetic answers definitively. Moreover, the psychological advantage cannot be overstated. The weekly chart trader sleeps peacefully, knowing his position is based on solid structural support. The hourly trader suffers constant anxiety, watching every tick, knowing that any moment's volatility could trigger his tight stop. Mathematics and psychology both favor the higher time frame. Ignore this lesson at your financial peril. Allow me to share with you the most important insight I have gained from decades of studying market behavior. The movements of prices are not random, nor are they the chaotic result of millions of individual decisions. They are campaigns carefully planned, methodically executed operations conducted by the composite operator for the purpose of accumulating stock at low prices and distributing it at high prices. But these campaigns can only be recognized and understood when viewed from the proper perspective. I have identified 4 distinct phases through which every significant market move must pass: accumulation, markup, distribution, and markdown. Understanding where you are within this cycle is the difference between aligning yourself with the powerful interests that move markets and becoming their victim. Yet I observe traders daily who cannot identify these phases because they are staring at time frames too brief to reveal the larger pattern. Picture yourself standing with your nose pressed against a massive painting. You see brushstrokes, individual colors, perhaps a small portion of detail, but you cannot comprehend what the painting depicts. You must step back, you must gain altitude to see the complete image. The market operates identically. When you examine a 15-minute chart, you see only brushstrokes, individual transactions, momentary rallies and declines, the tactical maneuvering of the trading day. You have no context. Is this advance occurring within an accumulation phase where the operator is still building his position and the real move has not yet begun? Or are we in the final stages of markup where the operator is preparing to distribute to an eager public? The brief time frame cannot tell you. But step back to the weekly chart and suddenly the campaign reveals itself. You observe that for the past 5 months, this stock has traded in a well-defined range between $42 and $48. Volume has been consistently heavy on declines and light on rallies, classic absorption patterns indicating accumulation. Spring actions have occurred, sharp breaks below support that quickly reversed, shaking out weak holders and generating the last available supply. This is unmistakably phase 1 accumulation. Now the stock breaks above 48 on expanding volume. We have entered phase 2 markup. The operator, having completed his accumulation campaign, is now prepared to advance prices. Those who recognized the accumulation phase on the weekly chart positioned themselves correctly. Those who were watching only the hourly fluctuations missed the entire preparatory campaign and will likely chase the move at far higher prices. The same principle applies at market tops. The weekly chart reveals when heavy volume begins to appear on rallies that make little progress, the operator distributing his holdings to the enthusiastic crowd. The monthly chart might show an even larger picture. Perhaps this entire advance from $20 to $60 represents one complete campaign from accumulation through distribution. Without the perspective provided by higher time frames, you are a soldier fighting without knowledge of the battle plan. You react to each skirmish without understanding the war. The composite operator thinks in campaigns spanning months or years. Position yourself according to the phase of the campaign visible on the weekly and monthly charts, and you transform yourself from victim to informed participant in the market's grand design. Now, gentlemen, we arrive at the moment of decision. I have laid before you 6 fundamental principles, each supported by logic, observation, and decades of market experience. The question is not whether these principles are true. The evidence is overwhelming and irrefutable. The question is whether you possess the discipline and wisdom to apply them. The path of the amateur is well worn and easy to follow. Watch the screens all day. React to every wiggle and fluctuation. Place tight stops that get triggered by normal market breathing. Chase breakouts on the hourly chart that collapse within days. Remain perpetually confused about market direction because you lack the perspective to see the larger campaign. This path requires no discipline, no patience, no real thought, and it leads inexorably to the transfer of your capital into the pockets of those who understand what you do not. The path of the professional operator demands more of you. It requires that you step back when every instinct screams at you to lean in closer. It requires patience when the world celebrates action. It requires you to maintain weekly and monthly charts when others mock such old-fashioned methods. It requires that you position yourself based on structure and principle rather than excitement and emotion. But consider what this path offers in return. You will see cause being built when others see only dullness. You will recognize accumulation when the newspapers declare a stock dead money. You will enter positions with mathematical precision, placing stop at structurally significant levels rather than arbitrary distances. You will align yourself with the composite operator, the smart money, rather than against him. And most importantly, you will accumulate capital steadily and systematically. While the crowd experiences the frustration of being perpetually on the wrong side. I cannot make this choice for you. No instructor can. You must decide whether you will be the professional who profits from understanding market mechanics, or the amateur who provides the liquidity that professionals require. You must decide whether you will view markets from altitude, seeing the grand campaign, or remain at ground level, confused by the daily skirmishes. But understand this clearly, the market will teach you these lessons one way or another. You can learn them now through study and the application of sound principle, or you can learn them later, through the painful and expensive education of repeated losses. The choice is yours, but the lesson is inevitable. Step back, gain altitude, study the higher time frames. Position yourself with the composite operator, not against him. This is the path to consistent success in speculation. Everything else is merely expensive noise. The market awaits your decision.